Good morning, everybody. Thank you very much for joining in. This side, Rahul Magan here as the Chief Executive Officer of Treasury Consulting LLP. And today we are going to covering another fantastic videos on financial instrument and derivative, which is AS30, Accounting Standard 30, which is by Institute of Chartered Accountants of India. Of course, now we have IND-AS 109, and shortly, probably tomorrow or day after, we would be covering a presentation on IND-AS 109, shortly known as AS 109, which is Accounting Standard 109. As we all understand that, not to mention that AS 109 is to an extent a copy of IFRS 9 and IFRS 13, but still we would be covering a dedicated presentation on AS 109. And today we are giving a special presentation to AS 30, which is Accounting Standard 30, AS 30, 32. AS 30 is Financial Instrument and Derivative, AS 32 is the fair valuation. So let me clarify again. FS 157 and 133. 157 is fair valuation and 133 is derivative accounting. IFRS 9 is derivative accounting and IFRS 13 is fair valuation. Similarly, AS 30 is derivative accounting and AS 32 is fair valuation. AS 109, which is I would say nothing but the copy of IFRS. AS 109, Accounting Standards 109. This is nothing but IFRS 9. Of course, I think if I'm not wrong, that by April 2018, Indian companies need to comply with AS 18. Sorry, my mistake. Need to comply with IND-AS. So whereby AS 109 would play a very important role. And just to remind you that Hedge Consulting LLP Training Desk is having a dedicated program covering accounting standards, whereby we offering a lot of trainings in accounting standard include US GAAP, IFRS, AS 109, IND-AS, and respective. So moving forward, the presentation would be covering an overview of AS30. We would be covering the derivatives. We would be covering financial instruments, hedge accounting, and key challenges. This is how the presentation would. Look like. The main objective is to establish principles for recognizing and measuring financial instruments. Because what is the scope of AS30? The main objective is to establish principles for recognizing and measuring financial instruments whose definition causes more items, financial asset, financial liabilities, and so on and so forth. One thing which we really need to understand, and unfortunately with majority of the time people don't understand, is that people tend to sync hedge accounting with derivatives accounting. Please be note that hedge accounting is further divided into two parts. So there is a clear distinction between hedge accounting and derivatives accounting. The reason is derivative accounting includes freestanding accounting also. Freestanding hedges are those hedges which are taken without any exposure. But unfortunately, we tend to believe that derivative accounting is same as hedge accounting. No, that is not the case. Derivative accounting is far different than hedge accounting. Yes, overall hedge accounting is a broader term than derivative accounting. There is no doubt about that. But again, hedge accounting will further categorize into two parts, apparently, which is quantitative hedge accounting and qualitative hedge accounting. Non-apparently, hedge accounting is divided into two parts, which is hedge accounting for plain vanilla derivative instruments, and one is hedge accounting for exotic derivative instrument. That is. Examples of underlying, we have a lot of underlyings because we know what we mean by derivative. A derivative is nothing but a financial or non-financial instrument. In majority in the books you will find only a financial instrument. Derivative is nothing but a financial or a non-financial instrument whose value depend upon an underlying. Now underlying could be anything. It could be interest rate, commodity prices, foreign exchange, indices, credit rating, and other variable. In fact, you would be surprised that in US people are having weather derivatives also. Like they take position based upon weather, because there are a lot of places in US where weather take only minutes to change, and it can destroy the crop of thousands of millions of dollars in just few minutes. So people take weather derivative. In US, you would be surprised people take derivative on electricity contracts. So there are that is why the derivative market is the most deepest. In case there is somebody would ask you a question that define the most deepest derivative market, then it is unset United States. Unset United States. Moving further, there are three kind of basically three important things of or three traits of a derivative instrument which we are having. One, of course, its fair value will change with respect to an underlying. And remember, forward contract is not a derivative. There is no net investment which you need to do, and it is to be settled at a future date. This derivative which we are talking about, this derivative is an OTD derivative, over the counter derivative. On the other hand, we do have ETD derivative also, exchange traded derivative also. In the exchange traded derivative, we are going to have an initial investment in place, which is known as mark to market or valuation. Some people will also mention this as a valuation, valuation call and other stuff. So there is a difference. Actually, this particular presentation is covering more or less the OTC derivative, over the counter derivative. But in real sense, once you talk about ETD derivative, which is exchange traded derivative, then the things would be a little different, right? And of course, you have to settle in a future date. That is something which is pretty right. So as you know that there are a lot of derivative contracts which we have across the globe. Why we mention derivative here, which we explain you. You have futures, you have forward rate agreements. Forward rate agreements is a interest rate derivative. You would have futures, forward rate agreements. You would have swaps. You would have forward contracts. Forward contract is not a derivative, but there are certain kinds of forward contracts which are derivative. Then you have options. Option is a derivative contract. Now, swaps are of further a variety of kinds. Soon, we would have that presentation also, wherein we would be covering the dollar swaps, the reverse dollar swaps, and OIS. We have a video on OIS, which is overnight index swaps, and others. Then embedded derivatives. Embedded derivative is a derivative which is which is a part of the host contract. Now, what is embedded derivative? What is embedded derivative? Take an example. Convertible bond is an embedded derivative. Foreign currency convertible bond is an embedded derivative. Swaption is an embedded derivative. Call swaption and put swaption is an embedded derivative. There are a lot of lease agreements which are linked with inflation is an embedded derivative. Indian IT companies or information technology company pricing every year is based upon a clause called COLA. COLA stands for cost of living adjustment, which is shortly known as I would say inflation adjustment. Misnomerly, you can treat this inflation, but this is not actually inflation. This is inflation plus your extra plus an agreed increase because of the cost of operations and so on and so forth. So this is not exactly that inflation or core and non-core inflation. So what we need to do, there are a lot of specifications which we have when it comes to embedded derivative. You need to bifurcate the embedded derivative with the original derivative. Sometimes that bifurcation is possible, sometimes that bifurcation is not possible. So a lot of things which we need to consider in that. But majority of the time, these derivative instruments you will get to know in bonds, right? In bonds. Accounting for derivative contracts is very easy. It's not very difficult, and we are going to cover the accounting for the derivative contracts. But we are going to take a simple example. Believe me that accounting for derivative is something which I would say that something accounting for derivative is something which something varies from derivative to derivative, right? So you would have different accounting for options, you would have different accounting for forwards, and so on and so forth. Derivative which are excluded from AS30, you know that these are the normal sale purchase of the non-financial items which are excluded, and regular way derivatives, you know that regular way purchase and sale, these are also excluded. There is one which is known as wrong way derivatives, but wrong way derivatives has been not very much covered in here, in this AS30. But if you go to IFRS 9 and US GAAP 133, in fact, in my personal perception is in US 133 also the wrong way derivative has not covered correctly. It is IFRS 9 where it has covered very correctly. So IFRS 9 and IFRS 13 where it has covered correctly. This is the definition of the financial instrument. Unfortunately, people say that there are two ways of financial instrument. One is, of course, financial instrument could be your asset. Financial instrument could be your liability. But remember the fact that every financial instrument cannot be hedged. Income taxes cannot be hedged. Inventories, of course. Cash and cash equivalent, of course. Trade and receivables, of course. Investment in equity shares, definitely not. Definitely not. Financial assets to be hedged, not a financial instrument. Financial asset is not a, and so on and so forth. Gold is not a financial instrument. Income tax is not a financial instrument. Inventories are not a financial instrument, but can be hedged. Cash and cash equivalent is, this cannot be hedged. Number one cannot be hedged. Number two can be hedged. Number three can be hedged. Number four can be hedged. Number five cannot be hedged. And number six can be hedged. Right. Moving further, when it comes to from the loan category, we have FS 95, which is the accounting on debt instrument. This divided debt instrument into three parts, which is available for sale, held till maturity, and held for trading. So the presentation which we are showing as per IS 39, this is International Accounting Standard 39. So International Accounting Standard 39 divides any derivative instrument financial assets into four parts. Number one, which route through P&L, which misnomerly is also known as fair value hedging. Another is held for trading, or sorry, held till maturity, available for sale. And then we have loans and receivables. Loans and receivable will also pass through P&L. This is how financial asset classification we have. If it is for trading, of course you have to take the P&L in your books. If it's for available for sale, then you have to determine the time and maturity. Available for sale is of two types. Technically, available for sale is of two types. One is available for sale and one is held for trading. Now there is a big difference between available for sale and held for trading. Available for sale is a smaller bucket. Take an example. You are talking about a bank, say Goldman Sachs. Goldman Sachs bond trading would be, I'm sure that they would be having billions of dollars of exposure in their bond trading. Now that doesn't mean that everything is available for everything is for sale. There must be certain quantity of the bond which Goldman Sachs has kept is at held till maturity, which they will of course redeem, or which will of course mature only on the maturity. We have much few bonds by Goldman Sachs which are held for trading. Now this held for trading could be, of course, this is not 100%, but this is not 0% also. But amongst that held for trading, how would you get to know whom to do, whom not to do? So for that we have a financial formula called CTD, cheapest to deliver, and especially in the fixed income bond market. And we allocate certain part of that held for trading to another basket which is known as AFS, available for sale. So as and when we get a client, we will go to that basket which is available for sale and do our transaction. But remember very carefully that available for sale is a smallest bucket than held for trading. On the other hand, held till maturity is something which you do on your maturity. The benefit of held till maturity is that gains and losses can be amortized over the period of the time. On the other hand, held for trading and available for sale, you need to take mark to market impact every month, because of course you will close your books every month. So you need to take mark to market impact every month in your books. Henceforth, during presentation, it seems fancy that one should have everything as held for trading or available for sale, but you need to park the mark to market losses in the P&L, which could be debit side, could be credit side. So held till maturity, held for trading and available for sale, they both are earning supplies for the company. This is the small example which we have taken into consideration. Yeah, you have a bond which is 6% convertible at the end of the year. Suppose it is issued at par. So you have a bond which is issued at par. It's a 2000 rupee bond, and you have purchased number of bonds and total turnover to be 20 lakhs. So this is a small example which we have taken. This is how we are going to do. We are going to calculate the present value of the bond, and then we are going to calculate the present value of the interest also. Once we're done with the present value of the interest and the present value of the bond, we know the total liability which we need to pay to that particular client. Liability would be same, liability would differ if we take the different yield. On the other hand, it would be same if we take the same yield, and yield would never be the same. The difference between the what we would receive from the debt instrument and whatever the net present value, it would hit the equity part, which is OCI, other comprehensive income. This is how we are going to take the accounting for any fixed increment or fixed instrument as per IS 39. On the other hand, if you go to US GAAP 157, then this accounting would surely differ. So this is what hedging is. This is a technical definition of the hedging, and I would like to stress a simple definition of the hedging. Hedging, in my opinion, is nothing but buying and selling in anticipation. On the other hand, because it is a presentation, we have to mention a theoretical concept like perfect hedge. But I would like to stress the fact that there is nothing known as perfect hedge across the globe. Hedges are never be perfect, and you cannot have perfect hedges, as simple as that. Because a perfect hedge is a position in which you will mitigate the risk pertaining to an instrument with respect to the volatility in the market. That is not possible. In fact, the fair value hedges is never be a perfect hedge. There are a lot of people which are saying that fair value hedging, you are able to mitigate the risk pertaining to the fair valuation in your books. I would absolutely agree with the same, and I am one of the proponents of that. But at the same time, I'm always saying that fair value hedges is not a perfect hedge, because there is always an error of estimation, because the exposure which you are calculating is different than actually the exposure at the time of revaluation. So there is not a single derivative instrument which is across the globe, in my personal opinion, and from the point of view of the practicality, not from the point of view of the books, that there is it is a perfect hedge. It is very difficult to create a perfect hedge position in this world, when exchange rate exchange when the contract, when the markets are moving on a statement of leaders, not practically on the statement of leaders. So this is very difficult, to be very honest. This is my personal opinion. There are three forms of hedges across the globe, and AS30 just copied that. We know that your US GAAP 157, 133, IFRS 9, IFRS 13, your AS 3032, your IND-AS 109. There are can only be three type of hedges we have in this globe. One is known as fair value hedges, one is known as cash flow hedges, and one is known as net investment hedges. Now, fair value hedges is nothing but the hedging of all foreign currency assets and liabilities in your books, which is subject to revaluation. As simple as that. Now that revaluation impact could go to your P&L debit, could go to your P&L credit, and of course this would act as an earning surprise. To mitigate an earning surprise, we are going to take a position which is known as fair value position. Misnomerly fair value position in India specifically, sometimes also known as balance sheet hedging also, but tactfully this is not a balance sheet hedging. Another other kind of hedging we have is the cash flow hedging. Cash flow hedging is a hedging which is you know that we will hedge the day in day out cash flow exposure. Some people further divide this cash flow hedging into two parts. People will say that cash flow hedging should be divided into two parts. One is the designated hedging, one is the non-designated hedging. So, and of course, we should not say that the entire impact will come on the P&L. As per hedge accounting, fair value hedges is ineffective hedges. As per hedge accounting, cash flow hedges to be test whether they are effective or not, and so would be the net investment hedging. But majority I have saw that net investment hedging portion is going to the OCI via equity. OCI stands for other comprehensive income. So it is your fair value hedging which hits your P&L, and once you take a contract which is a counter contract and the non-deliverable forward contract, then of course things would differ. Net investment hedging in going the OCI, which is other comprehensive income. So that is what the fair value hedging model. One side you would have hedged item, one side you would have the fair value of particular derivative contract, and both will go reverse. Remember the fact carefully, both will go reverse. So if you have a loss in fair valuation, which is known as revaluation loss, you would have a fair valuation gain, and this is non-deliverable forward contract. So this part which we are talking about, this part is a non-deliverable forward contract. right? Sorry, this part is a non-deliverable forward contract, and this part is known as revaluation. If you have a loss, you would have revaluation gain. If you have a gain, then you would have a revaluation loss. That is for sure. This is cash flow hedging, and why we are going to equity. Of course, we need to perform the hedge accounting, and if as per the hedge accounting, if it is effective in nature, then we need to put it in the equity, and if it is not effective in nature, then we need to put it in the P&L. And even if it is effective at maturity, the cumulative M2M of that derivative contract will reverse from the OCI, and it will hit the P&L. And this is known as reclassification adjustment. If you are listening to us and maintaining a diary, remember the fact very carefully that cash flow hedging is having reclassification adjustment. Both fair value and net investment hedging do not have anything pertaining to reclassification adjustment. So this is what we explain the hedge accounting. But all those who are maintaining diary, I would like to stress one fact that till few years ago we used to have two kind of hedge accounting. One is known as retrospective and one is prospective. Now accounting standard have phased out prospective hedge accounting. They said that everything is going to be retrospective and retrospective hedge accounting, and of course you need to maintain all hedging documentation and all such before moving further. This is what we have taken a small example of cash flow hedging. An importer forecasted that he would need a forward contract of $100,000. Foreign currency, we never mentioned dollar. The rate is 1.09. So you have taken a cash flow position and you are going to fair value this position at the end of quarter. Why am I taking quarter? Why I'm not taking month? Actually, it should be month. I'm taking a quarter because if you open an accounting standard FS 133 or ASC 1805, ASC stands for Accounting Standard Codification 805, you will get to know that at least quarterly you should have the hedge accounting to be performed, if not monthly. But of course corporates are closing book monthly, so they are doing on the monthly basis. In case the item comes to OCI, it will go to OCI. In case it comes to PNL, it will hit the PNL. This is what entries you supposed to be passed. This is nothing. This is the OCI entry. Majority of the time it's not very easy, not very difficult, the entries which you need to part. If you need the copy of the presentation, you can write to us rahul.magan@Consulting LLP. We will share with you. This is hedge effectiveness testing, which we are going to perform in. Now, how are we calculating hedge effectiveness testing? If you look at this part, this line, we are calculating the present value of a derivative divided by of a hedged item. This is very difficult, and this is where the dollar offset method will come into play, because we are calculating the hedge accounting using dollar offset, and as per dollar offset, it is present value of a derivative divided by present value of the hedged item. Hedged item could be payable, it could be receivable, it could be trade finance, it could be say standby letter of credit, it could be letter of credit, it could be any obligation. But don't forget that hedge accounting is between 80 to 25, and don't ask me why 80 to 25, because this is a law which is set up across the globe. I know this is obsolete, but still it is 80 to 25. Now you should have a formal documentation in place. You should have a proper hedge effectiveness hedging instrument in place. You should assess the hedge effectiveness. If you fail to calculate hedge effectiveness, then everything will go in the P&L, else everything would be a part of the equity. Hedging relations to be defined, hedge effectiveness to be measured on the monthly basis, the impact of hedge effectiveness to be go in the OCI, other comprehensive income, or it to go to the P&L. So this is something I want to check. Like I told you, 80 to 125 rule. This is nothing but the dollar offset. This is done on the basic premise of the hedge ratio. Hedge ratio is hedged by exposure. But the problem with the dollar offset method is that exposure is also to be calculated fair value, which is not the case with other instruments like regression, long haul method, hypothetical method, your others like all such methods. This is an example of dollar offset. If hedge is not effective, Then of course you need to take it to P&L and all the unrealized two steps. Number one, all the unrealized gain and loss pertaining to the hedge should be moved from P&L to his account. And secondly, on after all unrealized gain loss, then you need to then you will treat this in the P&L whatever gain loss you have, and this is known as reclassification adjustment. This is how the net investment hedging. I already told you that the net investment hedging, whether this is effective or ineffective, it will go to the equity side, which is other comprehensive income that you need to do. But net investment hedging is a very important concept, but unfortunately, very limited companies are doing that. Very limited company. So these are the challenges which we have with AS30. My personal opinion suggests that AS30 is not a foolproof system, and it doesn't have most of the new things of IFRS 13. At the same time, I don't think that of course, we were going to have a presentation at AS109 is also a foolproof system. In my personal opinion, IFRS 9 and IFRS 13 is much more beautiful. So we thank you very much, and we really wanted to associate with you. You know that our website www.treasuryconsulting.in. My mobile number is 9899242978. We wish you all the best, and you are most welcome to join our training programs via our online academy, which is TR Consulting, and could we do any kind of consulting with us. You know our contact details 9899242978. My website, my email ID rahul.magan@treasuryconsulting.in. Thank you and have a good bye.